Hello, my name is David Meloche. I'm the head of international equities at Montrusco Bolton and manage your recently launched NBI Active US Equity ETF. This is a brief comment on the first quarter 2021. In terms of market review, this quarter was not without its share of volatility, starting with Trump supporters taking over the Capitol in DC, then the Biden administration announcing two major stimulus proposals, the COVID plan in January for $1.9 trillion, and the more recent infrastructure plan this March for $2.25 trillion. Big numbers, ongoing deficits, more money supporting the economy and the markets. On the COVID front, J&J's one-shot vaccine came out at the end of February, and by mid-March, the United States had vaccinated over 100 million Americans, 49 days ahead of schedule. Both these developments helped support the reopening reflation trades that dominate the market narratives. And these narratives have had a profound impact on fund performance. Since its recent launch, February 2nd, 2021, your funds posted a positive performance of just under 1%, a little higher than the S&P 500 at 0.8. But the slight beat masks large opposing contributors to performance. For a number of quarters, in the funds we manage, our quality and growth style biases have been a headwind to our excess return. Think cleaner balance sheets, higher profit margins, less volatility in the earnings base, plus our growth bias and the higher valuations that these characteristics entail. Not in favor, factors working against added value. We faced about a 2% negative impact from these factors. The good news is our stock selection effect has more than offset the headwind. In terms of changes to the portfolio, first, we've been working hard at compressing the portfolio's valuation premium to minimize the style headwind. We won't compromise our quality and growth biases. That's our DNA. It's embedded in our process and defines our investable universe. But since last August, we've been proactive in protecting our added value from the reflation trade, favoring lower multiple stocks. Last August, our portfolio PE was 40% above benchmark. At the end of March, the premium was 20%, still a headwind, but less than if we hadn't acted on the risk. Another change in the last few quarters has been our trading activity. I've been managing our foreign equity funds for the last 12 years, and this last year, the opportunities to book profits and reinvest into better ideas have come at a much faster pace. In terms of outright exits and add in the quarter, we sold 3 investments that had performed extremely well, added 2. The US equity fund owns 27 names. We exited Activision. We felt the expected video game engagement levels will drop more than what is priced in as society reopens and we think the stock would now underperform. Estee Lauder has outperformed consumer discretionary names by 30% since October. Since it's still a great growth company, but we saw better investments elsewhere. Lastly, Interactive Brokers, the trading platform, with people staying at home and a higher savings rate, more people opened accounts and traded. We felt this enthusiasm was unsustainable, and the 25% outperformance left us with very limited excess return potential. We added Costco right after the dip, March 15th. We felt the online business is still being undervalued. It offers complementary product lines with the potential to enhance membership growth, improve retention over the midterm. We also added Five Below, a physical store base, a niche retailer facing attractive lease opportunities in this post-COVID world, and we feel the estimates, especially on the margin side, are still rather low. In terms of outlook, we expect the style headwind to abate. We do not believe in a new value decade of cigar butt investing. We feel this is a reversal of some near-term COVID overreach and a recognition of the higher potential discount rates going forward. We'll also really enjoy this current environment, the higher market volatility, investors focusing on one narrative then another, having compounding uncertainty surrounding growth levels, debt levels, the shifting supply chains, the changing consumer behaviors, digitization. We find lots of opportunities to disagree with consensus and generate differentiated perspectives on the evolution of the business models we focus on. If we can continue to be right more often than we're wrong, then we should generate value for unit holders. Thank you for your time.